This is part 4 in a series of discussions about banking. What I want to talk about in this discussion is what happens when you have a central bank and what is its relationship to the individual banks in the country. Now, the individual banks in the country, say they take all of their deposits and loan them out. Let's say for instance they lend them out in mortgages. Well, normally you would say the incentive for the bank when they're loaning out all this money in mortgages is to make good loans so that the money would be repaid and they would get their interest. And normally that would be the actual incentive thing, the thing in the best interest of these banks to do. Now, when you add a central bank into the picture, that picture changes. And the reason it changes is because of the discount window. The central bank has unlimited funds that they can create to prop up these banks. Now, the banks, it has to be understood that the banks only make money off of interest. So the more loans they can make, the more interest is paid to them and the more profitable they are. Okay, so when you have this discount window, it decreases the incentive of the banks to make good loans because they know that the central bank can bail them out. So this is precisely what happened during the last crisis with the mortgages. The banks started making a lot of loans that they knew were financially unsound and that many of them wouldn't be paid back. And they were relying on either the system not collapsing in the end through some magic or being bailed out by the central bank. So that's precisely what happened when they started making all these bad loans, and they all started to go bad over a period of many years. They all started to go bad, and the central bank came along and saw that all these banks were going to collapse because they had made all these bad loans, wouldn't be able to pay any of their depositors back. And so they bailed them out. They just created money out of thin air, deposited it in these banks' accounts, and prevented them from collapsing through their bad loans that they had made. So the fact that the central bank was there contributed to the fact that these banks were willing to make these bad loans. And in fact, in the end, most of these banks were bailed out of the bad loans that they had made by the central bank. Well, who paid for that when these banks were bailed out? Of course, it was the taxpayer, because when the central bank creates money out of nothing, which is all that they're doing here, and deposit it in these bank accounts, that dilutes the amount of money in supply and causes inflation, and the people that end up paying for that is the United States taxpayer. Now, in the next film, I want to discuss in a little more detail what the relationship is between the central bank and the federal government, and why the federal government allows this to continue.